Welcome back to The Explainer. Today, we're ripping right past the surface level of retail trading charts and taking a seriously deep dive. We're going to peel back the layers to reveal the actual mechanics of institutional market execution. We're talking about the tools the big players actually use and the hidden, high-speed algorithmic warfare that's taking place behind the scenes of literally every single price movement.
Okay, let's dive into this. It's the million-dollar question, right? Are you trading the market, or are algorithms trading you? It's a pretty provocative question for sure, but by the end of this explainer, you'll see exactly why we need to be asking it. We are taking a journey from those visible, simple chart lines that most retail traders rely on, straight down into the invisible algorithmic abyss where the real money is made and lost.
Section 1. The institutional anchor point. Beneath the surface.
You really have to think of the market as a giant iceberg. What you see on a standard chart, the daily highs, the lows, the standard moving averages, that is just the tip of the iceberg. If you want to understand the hidden depths and, honestly, the fundamental difference between retail and institutional traders, you've got to look at how they treat the volume-weighted average price, or VWAP. A lot of retail traders look at VWAP and just see another moving average, maybe a slightly fancier one for basic pattern recognition. They're essentially playing checkers. But institutional traders, they're playing chess. For them, VWAP is absolutely not just a line. It's a critical execution benchmark and a real-time liquidity map showing exactly where real money has changed hands.
Now, while a standard vwap resets at the opening bell every single day, smart money often relies on anchored vwap. This is the volume-weighted average price tied not to some random time on a clock, but to a specific high-impact informational event. We're talking earnings releases, massive news announcements, or a Fed meeting. Institutions just don't think in terms of arbitrary daily sessions. They think in terms of events. By anchoring VWAP to these major catalysts, it fundamentally helps traders analyze market responses to those events. It creates these massive gravitational anchor points that dictate the true support and resistance levels for weeks or even months down the line.
Section 2. Price action in volume. Practical integration.
So to actually map the market accurately, you have to integrate anchored VWAP with other volume-based indicators. First up, you combine it with the volume profile. When an anchored VWAP line perfectly intersects with a high-volume node, boom, you discover a confluence anchor. These are massive institutional power zones. Next, you've got to look at the slope. A flat VWAP slope, that just indicates market balance. Buyers and sellers are matched. But a steep slope, that reveals aggressive institutional flow and true market bias. Finally, you find institutional consensus by looking at multi-time frame alignment. When the daily, weekly, and monthly VWAPs are all stacked in the exact same direction, you are looking at serious, unified momentum.
All right, so how do we actually use this for trade entry timing? It boils down to a super clear 3-step tutorial. Step 1. Pause. Wait for a clear price action signal right at that VWAP level. But hold on, don't jump in just yet. Step 2. You absolutely need volume confirmation. High volume at this level is the proof that institutions are actually participating and actively defending the zone. And step 3. Confirm that your directional bias aligns perfectly with that higher time frame stack we just talked about. Combining these 3 elements with your price action massively improves your trade entry timing. And honestly, it keeps you from getting trapped by those brutal false breakouts, which, more often than not, are just institutions grabbing liquidity.
And this brilliantly illustrates the mathematical boundaries of normal price action once you're actually in the trade. We aren't just staring at a single VWAP line. We're looking at standard deviation bands wrapped around it. Because guess what? Algorithms are mathematically programmed to interpret these exact boundaries. Price action contained within the plus or minus 1 band, that's about 68% of the time, and it's just normal market noise. But when the price hits that plus or minus 2 band, where 95% of action is contained, algorithms very often trigger mean reversion signals to violently snap the price back to the VWAP. And if it hits the 3 band, you are witnessing an extremely rare 0.3% massive breakout or extreme overshoot. Understanding this framework is absolutely crucial for distinguishing between trend continuation and a mean reversion snapback.
Section 3. The VWAP execution game. Institutional trading.
Let's put ourselves in their shoes for a second and consider the execution dilemma. Imagine a hedge fund needs to buy 1 million shares of Apple. They obviously can't just hit the market buy button on their keyboard. Doing that would instantly spike the price, causing them to suffer massive slippage and literally costing their clients millions of dollars. Because of this reality, institutions are forced to slice their massive orders into tiny, microscopic pieces. They use execution algorithms to slowly drip these orders into the market over time, with the ultimate goal of keeping their average fill price as close to the market VWAP as possible. It's all about strictly minimizing their footprint. But here's the catch. Static rules, like just executing evenly over time, they simply don't work in highly dynamic markets. So institutions are now using cutting-edge deep reinforcement learning. Essentially, this is AI that learns by trial and error to mitigate transaction costs. Take the M3T architecture, for example. It splits the workload into 3 distinct AI levels. First, the macro trader uses long, short-term memory neural networks to predict the entire day's volume profile and allocates tranches. Then the MetaTrader dynamically selects sub-goals based on real-time, instant liquidity. Finally, the microtrader executes the child orders at the exact right millisecond using a self-attention encoder. They are dynamically adapting their parent order allocation in real time to completely hide their massive size. It's wild stuff.
Section 4. The backrunning threat, the algorithmic antagonist.
Which brings us to a highly controversial practice in modern markets. As Larry Harris once noted, order anticipators are parasitic traders. They profit only when they can prey on other traders. We are talking about the threat of backrunning. This is where high-frequency algorithms use incredibly sophisticated pattern recognition to parse through publicly available order flow. Now, they aren't predicting the fundamentals of a company, they're simply ascertaining the existence of a large hidden institutional buyer by looking for those subtle footprints left behind by the execution algorithms we just talked about. And incredibly, these backrunning algorithms operate in microseconds, literally thousands of times faster than the blink of an eye.
Let's move to and see how this actually builds across a timeline. This is a classic 2-period economic model of strategic interaction. Right here, at time 1, a fundamental investor, let's say a big mutual fund, begins executing their massive order. They think they're being super quiet. But the moment time 1 closes, a high-frequency backrunner completely analyzes the public data and extracts a signal. They figure out exactly what that mutual fund is doing. By the time we hit time 2, the dynamic has completely shifted against the fundamental investor.
And here are the specific mechanics of this interaction, mapped out by the FEES 2-period Kyle model. Notice how the backrunner begins with absolutely no actual fundamental information about the asset's real value, but simply by observing the fundamental investor's period 1 order flow, they gain a massive informational advantage. Moving into period 2, the backrunner jumps in and competes directly with the fundamental investor, essentially front-running their remaining orders. The backrunner legally exploits the fundamental investor's footprint, driving up the price and causing the institutional investor to suffer significantly worse execution prices in period 2.
Section 5. Randomization and camouflage.
At the end of the day, it all comes down to mitigating information leakage risk. Think about it. If institutional footprints are highly accurate and a backrunner can perfectly observe past order flow, then playing by static, predictable execution rules is mathematically fatal for the fundamental investor. If their vwap algorithms are just too smooth and too predictable, the parasitic algorithms will detect them every single time and drain their profits. Institutional investors must adapt their execution strategies to mitigate these risks. They simply don't have a choice. So the crucial point is that institutions have to fight back using heavy mathematics. To survive and avoid being backrun, they abandon predictable pure strategies entirely. Instead, they implement what game theorists call a mixed strategy equilibrium. They purposefully inject endogenous, mean-zero random noise right into their own order flows. To an outside observer or a backrunning algorithm, this might look like completely erratic market manipulation. An institution might actually sell a bunch of shares right before initiating a massive buy order, purely to obscure their true intentions and throw the backrunners completely off their scent. What looks like pure chaos on the tape is actually optimal mathematical camouflage.
We've really journeyed from a simple VWAP line on a basic retail chart all the way down into a hidden war of algorithmic deception and mathematical camouflage today. It honestly makes you rethink your entire market perspective. The next time you look at a chart, you really have to ask yourself, are your own trading strategies relying on the exact visible footprints that predatory algorithms are already preying on? Thanks for joining me on this explainer, and keep questioning what you see on the surface.